Hello, everyone, and welcome to another episode of Quick Claim Support Home Readiness series. It's great to have your company again, where today we'll be looking at all things co-contribution, so offering some practical tips around how it will work for you and your claiming processes, so that you can ensure, where possible, you can claim with confidence, efficiently, and quickly. So, as always, we do have a couple of points of housekeeping that we always like to raise. So, firstly, please do feel free to ask questions as we go using the comment feature on LinkedIn. If you do have any technical issues, please feel free to email me at tris@quicklane.com.au. And also, just a note for everyone that we are recording today's episode, so we can then, share it after the fact, and you can watch it at your own leisure. So don't feel like you have to be writing copious amounts of notes. You can watch this back when it is convenient to you. So it's now time for some introductions. For those that joined our last one, Luke will be a familiar face, but as always, Luke, it's a pleasure to have you join us today. Would you like to give the good folk a quick introduction? Introduce yourself.
Thanks, Triz. Hi everyone. I'm Luke. Thanks for coming along today or for watching retrospectively. I work in the sector, heavily focused on aged care for the last decade, and particularly home care. And I'm pretty much, I guess, a combination of working on technology solutions and business problems is where I spend my time. So, supported home's been a massive event for the sector, and very happy to be part of that journey.
It's a big journey, isn't it, Luke? There's a little bit of time before we go live, but it's exciting to have you here joining us today. For those that don't know me, my name is Tristram. I'm the content specialist at QuickClaim, as well as working in the NDIS. I'm also a participant, so I have that lived experience lens, which has helped me come up with a whole lot of content resources that demystify and de-jargonize what is the NDIA, and it's great to see support at home doing really well in terms of delivering some content that is easy to understand and easy to follow. So that makes me happy as a content specialist. So as I mentioned, today is all things co-contribution. So for those joining, you will be familiar with the introduction of co-contributions, which are very simply going to be for those Australians who are able to contribute to the cost of their home care services. And they're going to be calculated based on a percentage of the service cost and a whole lot of other variables. So before we get into the practical aspects of claiming for supports delivered and then recovering those co-contributions amounts, we do want to just very quickly dig into how those contributions are going to be calculated. So I mentioned the service types just now. So there's 3 service types within support at home, and each will determine exactly how much the co-contribution will be. So under the clinical care service type, there's going to be no contribution. The clinical care is things like nursing, allied health, nutrition, care, and restorative management. Whereas as we move along to independence service type, the co-contribution amount is going to be somewhere between 5 and 50%. And then we have the everyday living service type, and that co-contribution amount is going to be a little bit higher, 17.5 to 80%. So as we move to the next slide, service types play a key factor in calculating that amount, but there's a whole lot of variables like I touched on. So obviously within those independence and everyday living, there's a big wide percentage, 5 to 50, 17.5 to 80. Luke, I'm just going to throw it out there, give you the hard-hitting question. How does this actually work? How do we get that final figure for the contribution
Um,
amount, these variables?
Good question. So one of the, I guess, challenges for the sector has been that Services Australia, if we wind back 9 months or so, there was an expectation that letters would go out to clients explaining their co-contribution amounts. And then when we realised those letters weren't going out until after November 1st, not quite a challenge because we've got a whole lot of no worse off clients in today transitioning into the new model. They're about 80-20 broken down into clients who pay nothing in terms of co-contributions or income tested fees today. About 20%, 15 to 20% do contribute through an income tested fee. So we had that scenario to start with. We've got to manage everyone through transition, but then every new client who comes on board is going to be assessed against these rates. And I think with, you know, the formula that calculates how much someone will need to contribute is actually pretty complicated, and it does take into account a whole lot of external numbers and government variables and fixed figures and all sorts of things, and it will change year on year because of indexation and some other things. So someone's percentage might move around a little bit, but the broadly speaking, you need to know your income and your assets. You need to know, excluding your pension, how much is my income, and excluding my family home, how much are my assets worth. Those are the two kind of key guiders that feed into the formula. And we've got a little tool on the Blue Bike website as well that's like a simplified version of what the government, but it aligns exactly with. So you can come and check out on our free tools part of our website. There's a support at home, how much will I pay calculator. Just a free plug there. But that's just a tool to help the sector basically say, in the absence of information, can we quickly work this stuff out? So, thanks, Tris, for chucking the link in there.
It's a great resource. Highly recommend everyone
Yeah.
gives it a look because, like you said, it can be rather complex.
And we also don't expect people to be, it's really important that people talk about their private financial matters. We're not saving any data or doing anything like that. So this is just a tool to help sketch out what you might be out of pocket for different scenarios.
Perfect.
But yeah, certainly this is probably creeping into the mainstream media now, and I think over the next month will become more and more of a talking point, is what is the affordability of support at home for today's clients and tomorrow's clients? And I think co-contributions is at the heart of the affordability question.
Amazing. And in terms then of the practical, the calculations that go on behind the scenes, the question then is, providers, how do you factor in co-contributions when claiming? And as always, we've got this CSV upload graphic, which we often use to demonstrate where in that process the co-contribution element will sit. Do you mind talking through that a little bit, Luke, in terms of after claiming, when can providers sort of recover those co-contributions amounts? How does that work?
Yeah, I might even wind back a bit, Triz, just to the bit that says every client is entitled to know through their budgeting process what their out-of-pocket expenses are likely to be. We can't be precise at the budgeting phase because we don't know for sure exactly what will happen when that individual line item gets processed. But we can have a pretty good informed estimate at budgeting time, and that's important so clients can work out, okay, is $1,000 a year something I can afford or not, or do I need to tune my plan? So that's the preparation for co-contributing. And then we move into the actuals of co-contributing. And I would say, without going into too much of a rabbit hole, there was a phase of support at home about 12 to 18 months ago, when it wasn't clear at all if providers had to calculate these amounts themselves. And then, thankfully, a big announcement from Services Australia was, we will calculate these numbers for you. You do not need to do it. In fact, we don't want you to do it because you can only get it wrong because you don't have all of the information we have that goes into the formula. So that's great in that we can trust Services Australia to calculate these things for us, and we don't have to write so much code for the software that we use, or our vendors don't have to write so much code. But it still leaves the question of how do we plan for co-contributions and what that's going to be out of pocket. But certainly it was a huge relief to not have to write code, try and mirror exactly what Services Australia were doing behind the scenes. So we get to a claim for a line item, and it could be anything from an assistive tech home mod item or a restorative care outcome, nothing's off limits when it comes to co-contributions, except for clinical outcomes. So everything else is in scope: end of life pathway, restorative care, all of it. So we've got a line item, and we know how much we need to charge the client's package for, or claim from the client's package, and it enters that world of a CSV in this world, or APIs with Quick Claims World and others. Is that we load in an invoice amount, and at the payment summary, a few days later, we get back an answer from the government that says you need to charge your client this dollar amount for that service, and this is the amount we're paying, and this is the amount they need to pay. And at that point, the government's done with it. They don't actually track or follow whether you recover that amount. They just know that they told us as providers, this is what we need to recover. So that's kind of the flow, but the critical part is, and we'll talk about it in a second, is that that's not the job done. That's just knowing how much to invoice your clients for. It's not actually the end of the payment journey, and we'll cover that a bit more. But certainly the way this will work is we don't need to be telling Services Australia how much our clients owe us. We absolutely will be told by them how much they owe us.
That must be a relief that is the reality. That's going to make things a lot easier. But just to pick up on your points there, Luke, is this sort of conversation around revenue leakage versus revenue blockage. So certainly at Quick Claim, within our work within the NDIA, we support providers in ensuring that they don't have any revenue leakage. So these are things that, rejecting claims, supporting them to make sure that that doesn't get lost and they get paid for services that they delivered. It's slightly different in this space, to put it mildly, just in terms of the fact that this co-contribution element and other elements of support at home claiming can be seen as a revenue blockage, stopping people from actually claiming. Is that a fair assessment, and how does this sort of figure into support at home co-contributions?
Yeah, I think it's good that the two things coexist on the same spectrum. It's handy that they're the opposite, leaking and blocking. And we can think of support at home as we've got to make sure we unblock all of the revenue channels first and make sure we can claim for everything, from care minutes to indirect transport to assistive tech items to ongoing services, as well as the recovering co-contributions, which counts in that. Not just what can't you claim for, but what can't you get paid for. So I think, though, what we'll do is we'll start with a sense of blockage being the risk. And then once we open up all the channels and we're able to claim for everything because we've got all the processes and tools in place, then we probably move to the leakage detection mode, where we're trying to just make sure, okay, we've unblocked the pipelines. Now we need to make sure ongoing that there's no leaks. So I think it's probably important that right now organisations are in that mode of saying, how will I ensure that the revenue that we can claim for and get paid for is actually can come end to end? And we're talking today about co-contributions. So the government claims that's going to be 11 cents in the dollar across the sector, that 89 cents of everything in aged care will be paid by the government and 11 cents will be paid by the consumer in support at home. So that's the kind of broad number to be tracking to, of about 10% of our revenue, 10 to 11% of our revenue at macro level should be coming through co-contributions over time, depending on how accurate the government's predictions are, basically. So really, really important thing is to make sure we can get the revenue in from co-contributions. And that basically, we talked before about getting to the claiming process and getting through to a payment summary. If we know what we need to charge our clients, we're still blocked at that point from a co-contribution revenue perspective. We still haven't realized it, because we have to then bring that data into an invoice and turn that invoice into something that we can send to the client. And whether it's direct debit or whether it's a centre pay arrangement, or whether it's some organisations are planning for holding like a float, if you like, of clients' money that they're happy to put in and say, I'll keep you at $200 or whatever in the float, and you can just draw from there. Different approaches, but ultimately we have to get data out of Services Australia that says what are the line items to put on the invoices to the clients. And that's pretty much the magic of closing the whole loop. And then we're into a a debtor management scenario where hopefully we don't have people not paying their bills, but we know that will happen. So then it's all of that process. But critically, people are going to want to be able to trace in their mind. They saw something 9 months ago in their personalized, individualized budget that said they would be this out of pocket for these services. Then they're going to see things on their statements that talk about how much they're going to be contributing versus how much the government's paying for. And because this is real money out of people's hip pockets, this will really be a big test for the system in terms of, can we keep the trust and keep the faith of our participants that we're handling their money well and that we're only charging them for what they should be charged for. So I think it's a really important time for the sector to not lose the trust of the people whose money is basically now being relied on in the system. So,
And just in terms of the providers, then.
sorry, Chris, that was a very long answer. Did I actually answer the
No,
question?
that was a brilliant answer. No,
Yeah.
thank you so much. I always like to delve into the philosophical, so thank you for accommodating that philosophical question. I suppose, excuse my naivety, but just a little thought that occurred to me is that providers are going to have a sort of sense of what the timeline is going to be like for their cash flow, in terms of waiting for these code, because they're going to have delivered the service,
Yeah.
but because they're recovering code contributions amount, that's going to push out even further how long before they're actually paid.
Yeah.
What sort of questions should providers be asking themselves to ready themselves for that wait?
I think there's a change management piece with clients that we need to go through, that providers are going through right now in the way they're setting up service agreements and care plans and budgets for November 1st, where we need to be having conversations with our clients about, especially the brand new ones who aren't the no worse off people, the November 2nd clients who emerge, about essentially, helping manage their money well and making sure that they know that it's all going to the right things and they've got choice and control over it. And so I think that, as I said before, the risk level goes up, the settings, become much more serious. We're not talking about government funding here; we're talking about people's real money. And so, yeah, I think we're in a season of kind of having to live with and learn some new ways of working. And one of those is, if clients get volatile bills that come through every month, it's different, because today's income tested fee payers have a predictable amount that they will pay each month. Tomorrow's income tested fee payers will move to they won't pay any more dollar wise. They'll never receive an invoice that is more than what they would have paid under income tested fees. So they'll have a relatively stable financial outcome, but they will see that it's now being driven by all this activity and things, and in arrears charging for things. But then the November 2nd clients turn up, and I think very much they're going to be, all over this, wanting to know from the outset how much they're going to be out of pocket, and then being able to track it and trace it and make sure it's all being followed through. And because of the amount of revenue involved, we can't just write off like 50% as bad debts or whatever. There's got to be a really robust process to say we've got to actually follow through and collect these funds, and maybe 5% is acceptable. I don't know what the acceptable number is, but I have heard some people saying, they really struggle to get bills paid today for income tested fees, and this is going to really exert some extra. And I think if we can smooth out the co-contribution part for clients, we really should. It wouldn't be great for them to have a different amount coming out of their bank account each week. It would be nice to avoid that if we could, but it's going to require some different thinking.
Yeah, no, it's so well said, Luke. And yeah, that change management piece is going to be so incredibly important going forward as we prepare ourselves for November 1. We've mostly wrapped up our conversation today on contributions. If there's any questions, feel free to put them in the chat. We're going to be continuing this series into the future as we edge ever closer to that November 1st date, and certainly happy to provide more content to help demystify some of these issues, complexities that you might otherwise be facing. Is there anything else, Luke, that you'd like to add on the co-contribution piece? Any key takeaway for the good folks watching?
I think just a few wrap-up points is probably, we won't know officially what people's percentages are until after November 1st. So use the tools that are out there, whether that's Blue Bike's tool or the government tool, to help estimate these things in advance. we're going to have a whole lot of CHSP clients who are going. There's a huge number of packages going to be released. There's going to be a big influx. We have to be on top of this process of estimating co-contributions, and that will help with just having a calculator that helps start working out percentages. I think clearly the change piece around we've got a different accounts receivable process to deal with. I think I did an estimate 12 months ago of it's going to be probably 3 to 5 times harder to do accounts receivable under supported home than it was under HCP. Just much more complex, lots more moving parts, and so I think that real accounts receivable teams don't generally get a lot of love and affection in projects. They sort of quietly go about their business behind the scenes, and I do think they're a hugely important stakeholder in this process. Is how will we make a process that works for them to help them help their clients, basically. So they're probably my 2 areas: is make sure you start planning now and not saying, oh, they don't have their letters from Services Australia. There are other ways to get a quick estimate and be budgeting. And I've got a question here from Ben. Apart from lifetime co-contribution caps, are there any other factors that will change co-contribution rates for a participant? That's a good question, Ben. So before I talked about not wanting to write all the code to work out exactly how it all works, lifetime contributions is one that, as a sector, we have no visibility of. There's no one got a single point of truth data point that says this is how much the client's contributed to date, and then how much left until they hit the threshold of never contributing more. So that's one where Services Australia know the number and they apply the number to their calculations, and it would be folly for us to try and work that out and track it. Probably the other one is so that will change co-contribution rates for a participant. So technically, any financial change for a person actually results in a bit like the Centrelink it is a Centrelink process that says if your assets change, if your income changes, if your circumstances change, there's this whole long list of things. Like if you paint the front fence, then let us know and we'll change your co-contribution percentage. So it is an expectation that clients will keep up to date with Centrelink, and that's their relationship with Centrelink directly, to basically say, please make sure this is calculated properly. I've had a change of circumstances. So that's probably the other thing. And look, really importantly, providers shouldn't be relying on this percentage number as the claims process, as a feeder into the claims process. They shouldn't be going, okay, we've got to have those numbers on system so that we can calculate how much someone is going to have to be contributing. The numbers are useful for estimating someone's out-of-pocket expense, and that's the last time they're useful. You shouldn't. From there, it's all up to the government to tell us everything. So just want to leave you with a few of those points, I guess. And Ben, hopefully that answers your question.
Yeah, thanks, Ben, for asking the question. If there's any others, please comment them on LinkedIn. But this has been amazing as always, Luke. We really appreciate your insight and expertise to help make things a little bit clearer, bring a little bit of clarity to what is a monumental change, but one that is exciting for how it will support older Australians in their homes going forward. So
must be long answer Tuesday, Triz. Sorry for all the long and winding answers.
Great, yeah. I love it. I don't know if I'm answering, asking the long questions too. So there you go. Long questions and long answers. But I think we've done very well to get through what is a complex topic in so short a period of time. We don't seem to have any more questions flowing through, so we might call it there. Luke, thank you so much for time as always. We really do appreciate it. If anyone wants to reach out to you, Luke, how can they sort of...
easiest place is just find me on LinkedIn or luke.benson@bluebike.com.au, and you'll hunt me down. But LinkedIn's usually the easiest place to find me. I'm usually posting some normal stuff on there day to day, and sometimes some dad jokes, so come and find me on there.
I do. I have to admit, when I open my LinkedIn and I see the dad jokes, I always get a laugh. We need more of that on LinkedIn. So it's perfect. Thank you, everyone. Again, thank you, Luke. We'll return with another episode in the next couple of weeks or so, and we'll see you all then. Cheers, everyone. Bye.
Hey, everyone.